bilateral trade settlements between Russia and China have reached near-complete elimination of dollar usage, with over 95% of transactions now conducted in rubles and yuan, amid sustained geopolitical pressures and parallel financial infrastructure development. This milestone extends patterns observed in select intra-BRICS corridors, where local currency adoption has accelerated through bilateral agreements and digital platforms. As the expanded bloc advances pilot mechanisms for multilateral clearance, including the unit prototype with partial gold anchoring, these shifts contribute to incremental rerouting of commodity and manufacturing flows outside traditional dollar channels. Combined with ongoing reserve diversification and elevated precious metals demand, the trend underscores evolving transactional preferences in emerging market networks, raising implications for currency liquidity dynamics and hedging requirements in global markets. As of December 27, 2025, the bilateral trade settlements between Russia and China have advanced to a stage where direct conversions in rubles and yuan dominate, with official disclosures indicating that over 99.1% of transactions are now conducted in national currencies, marking a significant escalation from the already high thresholds observed in prior years. This progression, driven by robust interconnected banking linkages, established through platforms like the cross-border interbank payment system, and restrictions on dollar access for entities subject to international sanctions, underscores a deliberate pivot toward financial autonomy in one of the world's largest bilateral trade relationships. Valued at approximately $200 billion annually despite a noted 8.7% decline over the first 10 months of 2025. The transition mitigates foreign exchange risks inherent in intermediary currencies, particularly amid the dollar index's 9.4% depreciation this year, while substantially lowering transaction costs in energy and commodity exchanges that constitute the majority of bilateral volumes, with Russian crude and natural gas exports to China alone accounting for over 40% of the total flow. For Russian exporters, the predominance of yuan settlements provides a mechanism for stable revenue streams in an environment of volatile global pricing, as evidenced by Brent crude oscillations between $70 and $90 per barrel throughout 2025, though this introduces a nuanced dependency on Chinese monetary policy trajectories. Including the People's Bank of China's accommodative stance that has maintained the yuan's effective exchange rate index at around 104 amid controlled depreciation pressures. This arrangement bolsters overall resilience against external financial disruptions, such as those stemming from secondary sanctions or liquidity squeezes in offshore dollar markets, enabling sustained trade growth trajectories that have outpaced global averages despite nominal fluctuations tied to energy market cycles. Moreover, it establishes a replicable precedent for similar currency pairings within broader emerging market networks, influencing arrangements in BRICS and aligned corridors, where local currency usage has risen to 70–80% in select bilateral deals. The drivers underpinning this near-total shift to national currencies reflect a confluence of geopolitical imperatives and macroeconomic efficiencies, with interconnected banking infrastructures facilitating seamless ruble-yuan swaps through dedicated clearing centers in Moscow and Shanghai, processing volumes that have surged 25% year-over-year in non-dollar terms. Sanctions regimes, expanded since 2022, have constrained Russian entities' access to dollar-denominated facilities, prompting a strategic reorientation toward yuan-denominated reserves, which now comprise over 30% of Russia's international holdings, up from negligible levels pre-2022. This recalibration reduces exposure to currency mismatch risks in trade financing, where intermediary conversions previously imposed spreads of 1–2% per transaction, now largely eliminated through direct settlements that leverage digital protocols for real-time reconciliation. In the energy sector, which dominates bilateral exchanges with Russia supplying over 100 million tons of oil equivalent to China annually, yuan dominance stabilizes invoicing against global volatility, allowing Russian firms to hedge revenues more effectively via onshore yuan instruments amid Brent's persistent range-bound trading. However, this introduces interdependencies on China's policy framework, where interest rate differentials, with the People's Bank of China holding benchmark rates at 3.35% versus the Bank of Russia's 16%, could influence effective borrowing costs for cross-border deals, potentially amplifying transmission effects from Chinese economic slowdowns, as indicated by China's third-quarter GDP growth of 4.6% falling show. RT of targets. The resilience afforded by this model is evident in trade continuity despite external pressures, with bilateral volumes maintaining momentum through diversified payment channels that circumvent SWIFT dependencies, setting a benchmark for emerging economies navigating similar constraints. Economic logic further elucidates the benefits of this currency transition, as it curtails the opportunity costs associated with holding dollar reserves for settlement purposes, freeing up liquidity for domestic reinvestment in both nations. For Russia, yuan settlements have facilitated a buildup of offshore yuan assets exceeding 500 billion equivalents, providing a buffer against ruble volatility that has seen the currency depreciate 15% against the yuan this year amid fiscal strains from defense expenditures. This stability supports export-oriented sectors, where commodity price swings, such as liquefied natural gas spot prices fluctuating 20% quarterly, would otherwise erode margins. Instead, yuan-denominated contracts lock in predictable cash flows, enhancing corporate balance sheets and enabling reinvestment in upstream capacities. On the Chinese side, the arrangement secures preferential access to Russian resources at lower effective costs, as ruble settlements absorb some exchange rate risks, aligning with Beijing's resource security strategy amid global supply chain fragmentation. Yet, hidden risks emerge in the form of concentrated counterparty exposures, where Russia's reliance on yuan liquidity could exacerbate vulnerabilities during Chinese credit tightening cycles, potentially mirroring the 2015 yuan devaluation episode that rippled through emerging markets. Broader trade growth, projected at 5.7% annualized despite the 2025 dip, underscores the model's efficacy in insulating bilateral flows from global downturns, as evidenced by sustained increases in non-energy exports like machinery and agriculture, which have grown 10% year-over-year. Geopolitical analysis reveals how this settlement framework enhances strategic resilience, positioning Russia and China as anchors in multipolar financial architectures amid escalating tensions in commodity markets. The exclusion from dollar systems has accelerated the development of alternative infrastructures, including blockchain-enabled platforms that process over 50% of bilateral payments digitally, reducing clearance times from days to hours and minimizing intermediary fees that historically siphoned 0.51% of transaction values. This efficiency bolsters Russia's external position, with foreign exchange reserves stabilizing at $600 billion equivalents despite outflows, while enabling China to internationalize the yuan incrementally, now holding a 4.6% share in global payments per SWIFT data. The precedent extends to emerging networks, influencing BRICS initiatives like the Unit pilot, where similar local currency mechanisms are tested for multilateral application, potentially capturing 20% of block trade by 2027. However, dependencies on Chinese policy introduce latent risks, as shifts in yuan liquidity, such as the recent 4.62 billion ruble daily forex interventions by Russia's central bank, could transmit shocks, amplifying volatility in ruble-yuan cross rates that have varied 8% intra-quarter. Sustained growth in bilateral ties, despite the nominal decline attributed to softened energy demand, highlights the model's adaptability, with non-traditional sectors like technology collaborations expanding 15%, fostering deeper economic integration. Portfolio and reserve management implications are profound, as the shift prompts reevaluations among global institutions exposed to emerging market currencies. Sovereign funds in aligned economies, managing trillions, increasingly allocate to yuan-denominated assets, yielding 2–3% premiums over dollar equivalents in low-yield environments, while hedging ruble exposures through forwards that have seen volumes rise 30% this year. For multinational corporates engaged in the corridor, the transition necessitates dual-currency treasury operations, mitigating risks from policy asymmetries, but exposing them to basis spreads widening during geopolitical flares. Broader emerging networks, including ASEAN and African partners, adopt similar pairings, with ruble-yuan usage in third-party trades climbing to 10%, signaling a diffusion effect that erodes dollar transactional dominance gradually. Systemic ramifications permeate global finance, where diminished dollar demand in this $200 billion corridor contributes to offshore liquidity compression, potentially elevating funding premia by 20–30 basis points in stress scenarios. Reserve diversification trends, with gold and yuan shares rising in Russian holdings, provide buffers but underscore interdependencies that could cascade during Chinese slowdowns, as projected 4.5% GDP growth for 2026 poses transmission risks. The arrangement's resilience, tested amid 2025's energy volatility, positions it as a model for sanction-proofing, with trade sustaining despite external barriers. Monitoring forward indicators, monthly settlement disclosures, currency swap volumes, and policy alignments remains essential, as the framework's evolution could reshape liquidity hierarchies, with attendant effects on exchange rate stability extending into the medium term. As of December 27, 2025, the BRICS pilot mechanisms, spearheaded by the Unit prototype settlement instrument operational in controlled testing phases since its launch on October 31, 2025, facilitate multilateral local currency clearance across member jurisdictions. Leveraging blockchain infrastructure to enable wholesale netting outside conventional correspondent banking systems that have long relied on dollar-denominated intermediaries. This digital unit of account, structured with a reserve basket comprising 40% verifiable physical gold holdings, distributed across member vaults, and 60%, an equally weighted basket of core BRICS currencies including the Brazilian real, Chinese yuan, Indian rupee, Russian ruble, and South African rand, undergoes daily valuation adjustments to mitigate inherent volatility in the fiat component, thereby supporting the seamless handling of commodity-heavy intrablock flows in critical sectors such as energy, metals, and agriculture that dominate trade volumes within the expanded consortium of 10 full members. The infrastructure complements existing bilateral progress, exemplified by Russia-China settlements exceeding 95% in national currencies, by allowing trade imbalances to offset multilaterally through direct blockchain-enabled clearances, thereby reducing cumulative demand for dollars in extended settlement chains and lowering foreign exchange conversion costs that have historically inflated effective tariffs by 1–2% in cross-border deals. For participating central banks and financial institutions, the mechanism delivers verifiable transparency via immutable ledger protocols, significantly alleviating compliance burdens associated with anti-money laundering and sanctions screening in traditional rails, while fostering a pathway for gradual expansion to observer and partner entities, currently over 20 nations in accession discussions. Without compromising flexibility in the face of divergent fiscal environments across the bloc, where inflation differentials range from 2% in China to 6% in Brazil. The unit's blockchain foundation, reportedly utilizing a permissioned version of the Cardano network for secure and auditable transactions, as announced by the International Research Institute for Advanced Systems on November 10, 2025, ensures operational resilience in multilateral netting, with initial batches processing simulated volumes equivalent to hundreds of millions in trade obligations, positioning it as a scalable alternative to SWIFT dependencies that have constrained sanctioned members like Russia and Iran. Daily recalibrations of the currency basket, reflecting real-time exchange rate movements and gold spot fixes, counteract volatility risks inherent in standalone fiat arrangements, enabling stable settlements for energy corridors such as Russian natural gas exports to China or South African mineral shipments to India, which collectively represent over 60% of intrablock merchandise flows, valued at trillions in purchasing power parity terms. This complementary role to bilateral frameworks, where local currency usage has already achieved dominance in select pairs, internalizes payment liquidity within the bloc, diminishing incremental reliance on dollar funding markets that have seen offshore premia widen by 20-30 basis points amid Federal Reserve balance sheet normalization, contracting broad money by 4% year-over-year. Participating institutions benefit from lowered operational overheads, as blockchain transparency eliminates intermediary reconciliation delays, reducing clearance times from 2-3 business days to near instantaneous, while preserving monetary sovereignty in heterogeneous policy landscapes marked by China's accommodative injections and India's tighter inflation targeting. Macrofinancial implications of this pilot underscore a measured reconfiguration of global settlement preferences, where the unit's hybrid anchoring, 40% to physical gold, now valued at approximately 0.9823 grams per unit following market-driven adjustments, by December 2025, bolsters collateral integrity for commodity trades. Sustaining structural demand in precious metals markets amid constrained annual mine output of 3,536,000 tons. By facilitating multilateral offsets, the mechanism addresses imbalances that bilateral agreements alone cannot resolve, such as surplus yuan holdings from Russian exports being netted against Indian rupee obligations in agricultura. Deals, thereby optimizing reserve utilization and curtailing dollar accumulation in emerging portfolios where the currency's share has declined to 58% per IMF data. Compliance efficiencies arise from distributed ledger auditability, mitigating risks of jurisdictional disputes in sanction-prone environments, and enabling phased integration with national central bank digital currencies like China's eCNY, which has interfaced successfully in pilot simulations. This fosters expansion potential among geopolitically aligned partners facing similar infrastructure barriers, enhancing bloc cohesion without imposing uniform fiscal disciplines that could exacerbate divergences, such as Brazil's higher deficit trajectories relative to Russia's commodity-backed surpluses. Geopolitically, the unit's deployment signals a pragmatic advancement in de-dollarization efforts, complementing bilateral milestones by extending local currency clearance to multilateral scales, as evidenced by the bloc's trade volumes approaching 40% of global GDP on purchasing power parity, where energy and metals flows necessitate robust anchoring to circumvent unilateral restrictions on traditional systems. The gold collateral component, drawing on BRICS aggregate holdings exceeding 6,000 tons, introduces a neutral stabilizer that navigates policy asymmetries, ensuring the unit's acceptability across members with varying inflation regimes and reserve compositions. Reduction in dollar demand manifests through streamlined settlement chains, where multilateral netting compresses the need for intermediary holdings, potentially eroding offshore liquidity by 2-3% in affected corridors amid a depreciating dollar index at 98.05, down 1.55% monthly. Transparency features, inherent in the blockchain protocol, lower compliance burdens by automating verifiable reporting, alleviating the 0.51% fee structures of legacy networks, and promoting adoption among partners like Indonesia and the United Arab Emirates, whose commodity dependencies align with the bloc's resource focus, while maintaining flexibility to accommodate fiscal variances without mandating convergence. Reserve management dynamics are recalibrated through this infrastructure, as participating institutions leverage the unit for efficient imbalance resolution, freeing up capital previously tied in dollar buffers for domestic reinvestment, particularly in commodity exporting members, where gold backing enhances balance sheet resilience against price swings, such as platinum volatility impacting South Africa. Daily basket adjustments, informed by real-time data feeds, mitigate fiat volatility, supporting sustained flows in agriculture, where India's imports from Brazil have grown 10% annually, without exposing participants to asymmetric risks from currency mismatches. The complementary synergy with bilateral progress such as near-total Ruble-Yuan dominance in Russia-China exchanges, amplifies efficiency gains, reducing systemic dollar exposures that could amplify funding strains during stress periods, as observed in 2023 banking turbulence. For expansion to partner entities, the mechanism's modular design preserves adaptability, allowing accession without overhauling divergent environments, thereby strengthening collective financial sovereignty amid fragmented global trade norms. Portfolio strategists must navigate these shifts, where the unit's facilitation of multilateral clearance prompts reassessments of currency allocations, with emerging mandates increasingly favoring gold-linked instruments yielding 2–3% premiums over compressed Treasury real yields below 1%. Compliance alleviations through transparent ledgers streamline institutional operations, fostering broader uptake in sanction-constrained contexts, while the infrastructure's scalability, tested in controlled environments, positions it for absorbing 20% of block trade by 2027 projections. Flexibility in fiscal divergences ensures viability, as members with accommodative policies like China integrate without constraining tighter regimes elsewhere, maintaining equilibrium in multipolar finance. Systemic liquidity hierarchies evolve accordingly, with reduced dollar chains compressing premia in offshore markets, potentially by 20–30 basis points in high-volume corridors, as multilateral netting internalizes flows previously reliant on external intermediaries. Gold's anchoring role sustains demand floors, aligning with accumulation trends adding 800 tons block-wide this year, while daily adjustments safeguard against basket fluctuations tied to policy asymmetries. Expansion pathways to partners enhance network effects, drawing on commodity alignments to bolster resilience without uniform convergence mandates. Monitoring milestones, batch testing outcomes, interoperability with CBDCs and partner integrations remains critical, as the pilot's maturation could recalibrate global equilibria, with ramifications for currency stability and trade finance persisting into the medium horizon. In commodity sectors, the mechanism stabilizes invoicing, mitigating input cost variances for importers amid elevated metals pricing, while exporters leverage netting for predictable revenues. Corporate treasuries adapt hedging to incorporate unit exposures, reducing basis risks in divergent regimes. The broader trajectory exemplifies a deliberate maturation of parallel architectures, where local currency clearance extends multilaterally, underscoring the bloc's capacity to internalize risks and reshape dependencies in an era of geopolitical fragmentation. As of December 27, 2025, the incremental rerouting of trade settlement flows toward local currency and anchored instruments within emerging market networks, particularly through mechanisms like the BRICS Unit, prototype operational since late October 2025, exposes contingent risks to the dollar's liquidity premia in offshore funding markets, as rising shares of intrablock volumes, constituting a material and expanding segment of global commodity trade, gradually diminish marginal requirements for dollar-denominated invoicing and clearance. This migration, evidenced by bilateral corridors achieving near-complete local currency dominance, such as Russia-China settlements exceeding 99% in rubles and yuan, per recent central bank disclosures, aligns with broader reserve reallocation trends favoring physical gold and non-traditional assets, where BRICS aggregate holdings have surpassed 6,000 tons, following additions of approximately 663 tons in the first 9 months of 2025 alone. The process, while phased and primarily wholesale-oriented in its current pilot phases, with the unit facilitating controlled batch netting backed by 40% physical gold collateral, adjusted to market-driven valuations around 0.9823 grams per unit, could, upon broader uptake among geopolitically aligned partners, amplify volatility in dollar funding conditions during episodic stress. As observed in historical squeezes, where offshore premia widened sharply amid liquidity contractions, the capture of intrablock volumes by alternative instruments reflects structural efficiencies in commodity-heavy exchanges, where energy, metals, and agricultural flows predominant in BRICS trade benefit from reduced conversion costs and compliance overheads inherent in legacy correspondent networks. As local currency adoption scales incrementally, building on bilateral precedents that have rerouted substantial volumes outside dollar channels, the diminution in marginal dollar demand manifests through compressed invoicing needs, particularly in corridors representing 15–20% of global merchandise trade on nominal terms. This aligns with reserve diversification imperatives, where gold's elevated role provides a neutral hedge against fiat volatility, sustaining accumulation despite spot prices reaching $4,533 per ounce in late December sessions amid thin liquidity. Contingent vulnerabilities emerge in offshore markets, where Eurodollar and related funding segments have exhibited premia expansions of 20–30 basis points in recent quarters amid Federal Reserve normalization, potentially exacerbating if accelerated rerouting coincides with exogenous shocks, such as commodity price dislocations or capital flow reversals. Institutional portfolios, maintaining concentrated exposures to legacy dollar infrastructure, face heightened basis risks, where mismatches between invoicing currencies and funding sources could elevate hedging costs through widened cross-currency swap spreads, prompting refined strategies incorporating precious metals allocations or direct local currency instruments. The phased nature of adoption, confined initially to wholesale clearances with blockchain-enabled transparency, tempers immediate impacts, yet the framework's interoperability with national digital platforms positions it for measured expansion, potentially compressing dollar premia in emerging corridors by reducing transactional reliance on external liquidity pools. Reserve trends reinforce this trajectory, with gold shares rising to 18–20% in select BRICS balances, offering buffers against dollar strength episodes while indirectly supporting anchored settlement viability. Geopolitical fragmentation accelerates these dynamics as aligned partners navigate constraints on traditional rails, fostering internalization of settlement risks that diminish incremental dollar utility in high-volume flows. Volatility amplification remains contingent on scaling velocity, with simulations indicating potential 5,100 basis point premia spikes in stress scenarios if adoption encompasses partner networks facing analogous pressures. Liquidity management frameworks thus warrant proactive adjustments, incorporating scenario analyses for diversified invoicing and collateralized alternatives that mitigate asymmetric expos. Yours. Systemic implications extend to global monetary equilibria, where sustained migration contributes to a gradual reconfiguration of funding hierarchies, with offshore dollar segments vulnerable to compressed premia amid reduced marginal demand. Portfolio reassessments become imperative for entities with legacy ties, as basis risks elevate during transitions, necessitating enhanced cross-currency hedging or gold-linked positions, yielding relative stability in multipolar environments. The interplay with parallel digital infrastructures further entrenches rerouting potential, as wholesale mechanisms validate efficiencies that could absorb incremental volumes without disrupting bilateral gains. Contingent risks to premia highlight the need for vigilant monitoring of uptake metrics, including netted transaction scales and reserve contributions, as broader alignment among partners could precipitate adjustments in offshore liquidity conditions. Corporate treasuries embedded in affected corridors confront elevated imperatives for dual currency operations, mitigating risks from policy divergences while adapting to anchored instruments that stabilize commodity invoicing. The measured pace preserves stability, yet latent vulnerabilities underscore reassessment of frameworks reliant on dollar premia assumptions. Reserve managers in emerging contexts benefit from diversified anchors, reducing vulnerability to premia fluctuations while enhancing autonomy in settlement chains. Expansion pathways amplify network effects, potentially compressing dollar requirements over medium horizons. Monitoring quarterly disclosures on settlement shares and funding spreads remains essential, as incremental shifts accumulate ramifications for volatility and hedging efficacy in evolving trade finance landscapes. In commodity-dependent economies, rerouting buffers against dollar volatility, providing fiscal latitude amid price cycles, while importers recalibrate costs in non-traditional terms. The trajectory signals a deliberate pivot toward resilient configurations, with contingent premia risks demanding calibrated responses across institutional and sovereign levels.